The Barbell Portfolio. Why the smartest investors avoid the middle. Imagine I gave you two choices. The first investment has a 90% chance of making you 10%. But if you're wrong, you lose almost everything. The second has a 90% chance of doing almost nothing. But if you're right, it could change your life forever. Which one would you choose? Most people start calculating probabilities. But the smartest investors ask a different question. How much can I lose? Because building wealth isn't about being right all the time. It's about surviving when you're wrong and winning so big when you're right. That being wrong most of the time simply doesn't matter. This idea has quietly shaped hedge fund managers, professional traders, venture capitalists, and some of the greatest investors alive. It's called the Barbell Strategy. Unlike almost every strategy you've heard, it doesn't try to predict the future. It prepares you for futures nobody can predict. Today, we're building a portfolio based on that philosophy. Not one designed to beat the market every year, but one designed to survive uncertainty while keeping the door open for extraordinary returns. Because sometimes the biggest investing mistake is believing the future is predictable. And by the end of this video, you'll know exactly how to build a portfolio around that idea. The most dangerous place to invest. Where do most investors put their money? A little in stocks, a little in bonds, some cash, maybe real estate. In other words, somewhere in the middle. Not too risky, not too conservative, just balanced. That sounds reasonable. Isn't balance supposed to reduce risk? Surprisingly, not always. The middle often creates an illusion of safety. Imagine driving through the mountains, trying to stay exactly on the edge between solid ground and the cliff, thinking you're balancing both. You're not. You're just closer to danger. That's how many portfolios are built. They take moderate risks without earning extraordinary rewards. They accept average risk for average returns, for average outcomes. An average rarely creates extraordinary wealth. Years ago, a former options trader named Nassim Nicholas Taleb began challenging this way of thinking. You may know him as the author of The Black Swan. Taleb spent years studying rare events, financial crises, market crashes, pandemics, wars, the moments almost nobody predicts, and that completely changed history. Most investors spend their lives trying to predict these events. Almost nobody succeeds. So Taleb proposed something different. Instead of trying to predict uncertainty, prepare for it. Because if you survive every crisis, you give yourself the opportunity to benefit from every recovery. That's where the barbell strategy was born. Protect yourself from catastrophic losses while exposing yourself to opportunities with extraordinary upside. Notice this isn't pessimistic. It's actually optimistic. It assumes the next Amazon, the next Nvidia, the next technological revolution already exists somewhere. We just don't know where. We don't need to predict exactly what it will be. We only need a portfolio that lets us benefit when it finally arrives. The power of asymmetry. Let's imagine a coin flip. Heads, you make $100. Tails, you lose $100. Would you play? Maybe. Now, heads you make $100, tails you lose $1,000. Still play? Probably not. One more, heads you make $10,000, tails you lose $100. Suddenly the game feels completely different. Why? The odds didn't change, the payoff changed. That's exactly how the barbell strategy thinks about investing. Most investors ask, what's the probability I'll be right? Taleb asks something more important. What happens if I am wrong? A small mistake should never destroy your future, but one extraordinary opportunity can completely transform it. Taleb calls this positive asymmetry. Small downside, massive upside. Think about the biggest winners in investing history. Amazon, Apple, Nvidia, Netflix, Tesla, Bitcoin. At one point, every one of them looked risky. Many investors sold far too early, but the few who held long enough didn't just double their money. Some multiplied it 10, 20, even 100 times. Imagine investing just 2% of your portfolio into one of those companies, and it became a 50-bagger. That tiny position could outperform everything else you owned. One extraordinary winner can erase dozens of small mistakes. You don't need to be right all the time. You only need to avoid catastrophic losses while giving yourself exposure to extraordinary outcomes. Most investors get this backwards. They put 50% of their portfolio into one high-conviction stock, or chase the hottest sector after it's already doubled. That's not asymmetry. That's concentration. The barbell strategy does the opposite. It protects almost all of your wealth and takes calculated risks with only a small portion. If those risks fail, your life doesn't change. If one succeeds, it can change your financial future forever. This applies to life too. Most successful founders didn't bet everything on their first idea. They tested, failed, learned, and kept their downside manageable while searching for one breakthrough. Venture capital works the same way. Most startups fail. Investors expect it, because one company, like Google or Uber, can pay for every other investment combined. That's asymmetry. Not winning often. Winning big when it matters. Now let's build one. Not based on theory, but using real investments any investor can own today. Building the barbell portfolio. At first glance, this is going to look unusual. Everything you've learned about diversification says spread your money evenly. The barbell strategy does the opposite. It separates your portfolio into two worlds. One exists to protect your future, the other exists to change it. 90%, the safe side. This is where people get surprised. Why place almost all our money into conservative investments? Because the goal isn't to maximize returns. It's to eliminate catastrophic mistakes. Imagine spending 20 years building your savings. Would you want one bad investment to destroy everything you've worked for? 70% VOO. The largest position is still the S&P 500. Despite every crisis, every recession, every crash, the American economy keeps creating extraordinary businesses. You're not trying to predict the next winner. You already own them all. 20% SGOV. Short-term U.S. Treasury bills. Not exciting, and that's the point. SGOV gives you stability, liquidity, and a return while keeping capital available. When markets panic, this becomes your dry powder, so you're never forced to sell at the bottom. 10%, the asymmetric side. This 10% has a completely different mission. Not average returns, but extraordinary outcomes. I don't know which technology, company, or industry will dominate the next 20 years. Neither does anyone else. So instead of one giant bet, I spread that 10% across several asymmetric opportunities, expecting some to fail. That's part of the strategy. 2% Bitcoin ETF, one of the most volatile assets ever created. Could it keep appreciating dramatically? Possibly. Could it drop 70%? Absolutely. A small position, massive upside, limited impact if wrong. 2% Semiconductor ETF. Every technological revolution needs infrastructure. AI, cloud computing, autonomous vehicles, robotics. None exist without chips. 2% Robotics and AI ITF. The world is becoming more automated every year. Will every company succeed? No, but the trend could define the next decade. 2% Biotechnology ETF. Medical innovation has created some of history's largest winners. Most research fails. When one breakthrough succeeds, the upside is extraordinary. 2% Space and Emerging Technologies. ETFs, our wild card. Space, satellites, quantum computing. Maybe none of it becomes dominant. Maybe one reshapes the global economy. We don't need certainty, only exposure. Most portfolios try to make every dollar behave the same way. This one doesn't. 90% protects your financial future. 10% creates extraordinary possibilities. If every asymmetric investment failed, your financial life would still be intact. But if just one became the next Nvidia, Amazon, or Bitcoin, it could meaningfully increase your returns without ever putting your future at risk. You're no longer asking, which investment will definitely win? You're asking, how do I make sure one big winner matters more than several small losers? Why one great investment can change everything. Imagine it's 2004. Google just went public. Most people don't think it's worth buying. Now imagine investing just 2% of your portfolio. Not 50%, just 2. Fast forward 20 years, and that tiny investment becomes one of the biggest winners in modern investing. It's 2009. A struggling electric car company called Tesla. Almost nobody believes EVs will replace gasoline cars. Again, you invest just 2%. Years later, that position is worth more than many investors' entire portfolios. It's 2015. Almost nobody on Wall Street is talking about Nvidia. Gamers know the name. The world hasn't realized how important chips will become. Once again, just 2%. And once again, one extraordinary winner changes the outcome of the entire portfolio. You didn't need to predict the future perfectly or bet your entire fortune. You simply needed exposure. That's the entire philosophy. Not certainty, exposure. Venture capital thinks exactly the same way. Firms like Sequoia, Andreessen Horowitz, and Y Combinator know most of their investments will never become billion-dollar companies. Many will fail completely, and that's expected. Because one company like Google, Airbnb, Stripe, or Uber can return more money than every unsuccessful investment combined. Read that again. One winner pays for everything else. That's not luck. That's mathematics. That's asymmetry. Professional venture capitalists aren't trying to avoid failure. They're trying to make sure that when success arrives, it's big enough to matter. Most investors build portfolios that are almost entirely average, then wonder why extraordinary wealth always seems to happen to someone else. Very few people who got wealthy through Amazon, Apple, or Bitcoin invested everything. Most simply invested early, stayed patient, and gave the business time to grow. Time amplifies asymmetry. A 5 times return is impressive. A 50 times return can change a family's financial future. And here's my favorite part. Even if every one of those 5 aggressive positions failed, your financial foundation would still be standing. You'd still own the S&P 500, the Treasury bills, the liquidity, decades of compound growth. But if just one became the next Amazon or Nvidia, the reward could be life-changing. Small losses, potentially enormous gains. That's an asymmetric portfolio. Who should actually build this? So who is this strategy actually for? It isn't for someone who checks their portfolio every morning, or chases the hottest stock on YouTube, or constantly asks what's going to happen next. Because the truth is, nobody knows. Not me, not Wall Street, not the Federal Reserve. This portfolio is for someone comfortable saying, I don't know what the future looks like, and sees that as freedom, not weakness. Most people react to every headline. Rates go up, they panic. AI gets popular, they chase it. The market crashes, they sell, then buy back higher 6 months later. The barbell investor prepares instead of predicts. The future isn't something you forecast. It's something you survive. And if you survive long enough, you eventually participate in opportunities nobody could have imagined. 20 years ago, almost nobody predicted smartphones, cloud computing, or AI. Those innovations created trillions in wealth. The next 20 years might bring quantum computing, personal robotics, fusion energy, or space infrastructure. Maybe none of it happens. Maybe one of them transforms civilization. We don't know, and that's okay. The barbell strategy doesn't require certainty. It requires patience, curiosity, and above all, humility. The humility to admit the future will always surprise us. Stop trying to build a portfolio that predicts the future. Start building one that benefits from uncertainty. Recap. Today we built one of the most unconventional portfolios you'll ever see. Not because unconventional is better, but because conventional thinking struggles in an unpredictable world. We protected the majority of our wealth, accepted small, calculated risks, and gave ourselves the possibility, not the certainty, of participating in the next extraordinary breakthrough. That's what investing really is. Not predicting tomorrow, preparing for tomorrow. So far in this series, we've explored the growth portfolio, built for maximum appreciation, the modern diversified portfolio, built for balance and resilience, and now the barbell portfolio, built to survive uncertainty while embracing asymmetric opportunities. But what happens when you're no longer trying to grow your portfolio, but want it to start paying you? That's the cash flow portfolio, generating income through dividends, REITs, covered calls, and income-producing assets. And it's exactly what we'll build next episode. If you enjoyed this one, subscribe and follow the rest of the series. This isn't just a collection of investment ideas. It's a complete roadmap from building wealth to living from it. Remember, you don't have to predict the future to become wealthy. You simply have to survive long enough to let compounding and extraordinary opportunities work in your favor. A little wealth, built consistently, can become financial freedom. I'll see you in the next one.